South African operations are huge, and they also reflect the size of the South African economy relative to the rest of the continent. And so if South Africa was to grow at 1.7%, the impact that that would have on our bottom line is huge compared to faster growth, let's say, in Lesotho. So that's true as a general proposition. What is also true, however, is that the operations outside South Africa grow off the back of faster GDP growth. So in East Africa, the average is around 7%, Cote d'Ivoire, it's 7.5%. And any business that is operating in that environment where you are increasing the number of products you are selling to your customers, you're having a larger number of customers entering the system, and you're having investment, you are bound to grow faster than the rate of growth in the economy. That would explain why, in our case and in the bank that you're referring to, those operations outside South Africa are growing significantly faster than the economy. But let's not forget scale. The scale of the South African operations in our case is massive. The operations outside South Africa make up a third of our group. So, but that trend is a trend that is likely to continue.
Right, but then you're finding a situation whereby even with 1.7% growth, if we meet that, it's still an environment in which you're finding a consumer that is under strain. Perhaps you can describe to us the type of consumer that you are experiencing walking into your branches at Standard Bank. What are the pressures there?
Okay, Fifi. So what we've seen towards the end of last year is better consumer confidence, for want of a better word. You will have seen more people buying homes. So our home loans business grew by 4%. More people are taking out unsecured loans. So our unsecured loans grew by about 14%. Our business loans also grew by about 14%. Our vehicle and asset finance business grew by about 10%. Much of that growth happened in the second half of the year. So if you take the average of our balances, it's less than what it was when we closed our books at the end of the year. And that suggests that consumers are now much more active than they were in the middle or early parts of the year. It is true also that consumer confidence is starting to pick up and is starting to build. But I would offer to you that until corporates have more confidence and start investing and buying more plant and machinery, hiring more people, you will continue with the tepid growth that we have. So what we saw in our South African business was growth amongst our corporates in our corporate book of around 5%. And that is really tepid. But one would expect that as structural reforms happen in South Africa, you will see greater economic activity, more investment.
Sure, because it looks like everybody's just waiting to see what happens after the elections before sort of staying or moving from that fence in which they are possibly holding investments until they get more clarity. But quite a lot of change has already happened in the past 12 months under this new administration. I mean, from Standard Bank's point of view, has it been enough, and what else needs to happen for Standard Bank itself as an investor, as a business, to have more confidence in South Africa's economy?
I would look at it from the lens, let's say, of ratings agencies. Let's maybe use that analysis, and let's use Moody's and say to ourselves, well, Moody's is the only one of the ratings agencies that ranks South Africa as investment grade. Our securities business has looked at their model, and they've said if you do the quantitative analysis using their matrix, they're unlikely to downgrade South Africa because of the veracity of the fiscal plan that the country has spoken to. Now, there may be subjective factors that cause them to downgrade, but the quantitative aspects of it suggest that they will not. The subjective aspects have to do, in my view, with the structural reforms that you are referring to, dealing with the Minerals and Petroleum Resources Act and the mining sector, speeding up the ease with which people move in and out of the country by improving the visa processes, improving tourism, ease and speeding up broadband, dealing with the structural issues that are associated with state-owned enterprises. to the credit of the government, they've done a lot of those things already, which will create the confidence needed for people to invest.
The year ahead is also one in which Standard Bank is likely to face a lot more competition with the coming online of the various new banks, the various digital banks that they don't have bricks and mortar branches such as you. Are you guys worried about this competition, and how are you planning to protect market share?
I do believe, however, that we have an advantage as a bank that new entrants and fintechs and big techs do not have. We have got strong customer relationships, we've got vast amounts of data, we've got the capacity to manage risk, we've got lots of financial resources, and we've got strong brands. If we are able to improve the customer experience using all of these things, big data, data analytics, digitizing ourselves, working in a more integrated way, as is one of our objectives at Standard Bank, making absolutely certain that our customers are at the center of things that we do. It is our belief that we will survive the next 5 to 10 years. We will perhaps be different. We will be far more tech savvy. We'll have improved the customer experience, but we will arrive far more intact than other industries. For example, if you forgive me, we will not have a Kodak moment. Yeah.
Your outside of Africa operations now, or outside of South Africa rather. Let's start with the ICBC now. There is a view that you will be injecting quite a large sum of money into those operations. Can you just clarify Standard Bank's position on that business?
The view that we will be injecting capital is unfortunate because it is not entirely true. We may need to, dependent on the size and the speed at which our risk-weighted assets develop in that entity. So as we speak today, there is no need for us to make that investment.
Mm-hmm. And then when will you know, though?
We'll know when the risk-weighted assets grow. And they're not growing at the rate which would make it necessary for us to make the investment.
All right. And if you do, then this sum of $18
then we would make the investment.
million